Hey everyone! Welcome to our channel. If you're looking to build wealth and make smart investments, you've come to the right place. Today we will be discussing when to sell a stock and more specifically a common stock. This is a topic that even the most successful investors wrestle with. Before we get started, subscribe to our channel so that you're the first to know when we release a new video. Now let's dive in. Famous investor, Philip A. Fisher stated, "If the job has been correctly done when a common stock is purchased, the time to sell is, almost never." Warren Buffett has said that his favorite holding period for a stock is forever, and the point that he was making is that you should always purchase a stock with the intention of holding it forever. Therefore, make sure your money has been put into your best investment ideas. Author Robert Hogstrom has written several excellent books about Warren Buffett and his investment strategies. In the Warren Buffett portfolio, he says that an investor should leave his or her portfolio intact for at least 5 years, as long as the fundamentals for which a particular stock was purchased do not deteriorate. He also says investors should pay no attention to a stock's price volatility because it is a normal part of the investment cycle. In their book $1 Million Portfolio, the Motley Fool team says investors' minimum holding period for each stock that is purchased should be 3 to 5 years. As a long-term investor, there will be times when it makes sense to sell or reduce your position in a stock earlier than you had planned. Next, we will discuss different circumstances in which you should consider selling a stock or reducing your position in a stock. Reason number 1. The time frame. If you will need the money within 5 years, it should not be invested in stocks. It would be best to invest your money in safe and stable short-term instruments. Money market accounts, money market funds, and short-term certificates of deposits would be better options. Since the Great Recession struck, some investment professionals now recommend that you not invest any money in stocks that will be needed within 10 years. Reason number 2. The stock becomes overvalued. When a stock is significantly overvalued, sell it. Take the proceeds from the sale and invest them into other undervalued stocks that you have researched. The price-to-earnings ratio, or PE, is still one of the best indicators of value. For example, if a stock has traded at an average PE ratio of 15 for the last 7 to 10 years and the business is thriving, but the stock currently trades at a PE ratio of 30 or more on consistent or increasing earnings per share, you should seriously consider selling the stock. When a stock is overvalued by 50%, the Investment IQ Insights team would not hesitate to sell it quickly in order to put our money into other investments that are better values. Reason number 3. The company has too much debt. Too much debt is dangerous for any company because there's always the chance that the company will be unable to pay its debt. Too much debt also puts a company at greater risk of failure if a downturn in the industry or economy were to occur. Upon entering the 2007 recession, thousands of companies here in the United States literally disappeared overnight, and that was before things really got bad. We're willing to bet that those companies that were carrying too much debt were the first to go. We still like to refer to the debt-to-equity ratio when it comes to debt and like debt-to-equity ratios of 0.50 or less. The Investment IQ Insights team also likes companies to be able to pay off their long-term debt in 5 years or less based on their net income for the most recent 12-month period. For example, if a company has long-term debt of $850 million and net income of $125 million for the most recent 12-month period. If we divide the long-term debt of $850 million by the net income of $125 million, we get an answer of 6.8 or 6.8 years, which tells us that the company carries more long-term debt than we like. Try to stick with 5 years or less unless the company is some type of financial institution, such as an insurance company or bank. With those companies, don't be too concerned about long-term debt because it's normal for them to carry a lot of it. Reason number 4. The company takes on too much risk. Sometimes new management will come to a company and begin to implement new policies. Along with that implementation, they will knowingly or unknowingly expose the company to greater risk. If you purchase the stock of a company that stayed away from very risky practices in the past, but now the company has started to display risky behaviors that make you uncomfortable, sell the stock and find yourself a better investment. Reason number 5. The company loses its competitive advantage. We should only purchase the stocks of companies that have a durable competitive advantage. When a company changes its business model, resulting in the loss of its competitive advantage, sell the stock. Having a durable competitive advantage is essential to any stock that we purchase. The return on equity is still a strong indicator as to whether or not a company has a competitive advantage in its industry. Look for consistent long-term yearly returns on equity of 12% or more. Reason number 6. The portfolio lacks balance or diversification. It's very easy for your best performing stock to become the largest holding in your portfolio, and there's absolutely nothing wrong with that. The problem arises when the stock makes up more than 20 to 25% of your portfolio's total value. The Investment IQ Insights team would be very uncomfortable having more than 25% of our portfolio's value tied to just one stock. Legendary investor, Jim Slater suggests that individual investors limit the number of funds invested in a single stock within their portfolios to a maximum of 15%. When your portfolio becomes heavily weighted in one stock, consider reducing your position of that stock to bring more balance and better diversification into your portfolio. Reason number 7. The stock reaches your estimate of its fair value. Our goal as investors should always be to purchase a stock at a discount to its fair value, and we recommend at least a 25% discount to its fair value. By doing so, when you sell a stock that has reached its fair value, you are guaranteed a gain of at least 25% from the sale. This is a disciplined approach to selling a stock. According to research, it was common for Benjamin Graham to sell a stock once it had a 50% gain in price. If the future prospects of a particular stock looks good, you may decide to sell only a portion of the stock, such as half of its shares, and hold on to the rest when using this approach. Reason number 8, and the final reason. When you discover that your analysis of the company is flawed, there will be times when an investor will be very detailed and careful in his or her analysis of a particular company or its stock, only to find out later that his or her analysis is incorrect or flawed. When you find that you have incorrectly analyzed a particular business, it's essential for you to take a serious look at all available information to determine whether or not to sell the stock or to continue holding it. One thing is certain, as an investor, you will not always be right when analyzing a company or its stock. The Investment IQ Insights team has not discovered a clear-cut way to determine the optimal time to sell a stock, and we don't think even the best investors have figured that out. There will be times that you will sell a stock because it has not performed well, only to see it skyrocket and double or triple in price soon after you sell it. There will also be occasions when you have purchased what seems to be the perfect stock, only to watch it tumble in price and for no apparent reason. Even Peter Lynch, Jim Slater, and the Investment IQ Insights team have sold stocks too early or too late. It's going to happen. Learn from those events and move on. If you liked this video, we think you will like the 2 videos now appearing on the screen. Go ahead and click on one of them now to continue your investment journey. Thanks for watching. We'll see you in the next video.